Hi, my name's James Kazuni, and today we're taking you through the US Federal Reserve balance sheet analysis. Basically, there's a formula come up with that summarizes the balance sheet mechanics. So change in reserves equals the difference between QE and QT, and basically the interest expense minus the interest income for the balance sheet. I'll explain all these terms, yeah? So what is an interest and excess reserve expense? So in the fallout 2008, a lot of money was printed to buy US treasuries and mortgage-backed securities. This flooded the central banks, the banking system, with a ton of reserves. And the problem is that there was no demand for cash because banks already had it. And so they never went to the interbank funding market to get loans. And this kept interest rates always at zero. And it drove speculation on short-term duration investments, yeah? So this is a problem. And the Federal Reserve needs a new tool to raise interest rates. And what they used was an interest and excess reserve tool. And basically they'd offer 5.5% to all the reserves so that they wouldn't let out to me at a short-term rate at a high speculation. Yeah, they're going to get a guaranteed 5.5% from the Federal Reserve. So banks will now choose to lend to the Federal Reserve at 5.5%, and they're not going to lend out below this rate to anyone else. So now my interest rate goes up to 5.5%, and the problem is this costs a lot of money. As you can imagine, 5.5% every year to pay all these reserves, so they don't lend out to me. It's quite a lot. So the interest and excess reserve expense is the number of reserves in the system, which is all these added up, times the current interest rate, whatever interest rate the central bank wants to set. And this comes out to $176 billion a year. And there's also another expense the Federal Reserve has, and it's the money outside the central banking system or outside the banking system. And it's called the Fed's on repo expense. And it's called the Fed's on repo rate, or how much money is in the system, times the interest rate, which totals about 25 billion. I won't show you too much. I'll show you the balance, but I won't teach you that today. And this is the SOMA, or securities outright, that the Federal Reserve holds on its asset side of the balance sheet. So all these generate income for the Federal Reserve, and basically takes money out of the system. It's deflationary because banks are now paying money back to the Federal Reserve. This takes money out, and essentially the Federal Reserve generates around $81 billion a year in central bank income, with the interest rate or an average yield on all their bonds of 2.81%. And we'll be discussing this today. Okay, so this is the Federal Reserve balance sheet in 2014. As we can see, the interest income is $116 billion, and the interest expense was only very small because interest rates were at 0.25%. And this meant that we had a surplus there. So the interest, all this interest income from here, from these bonds, exceeded the interest expense, so they had a profit. But what did the central bank do with this profit, or the Federal Reserve? They sent it off to the US Treasury to basically fund deficits or reduce the deficit, yeah? And the problem is in 2024, now the interest expense exceeds, because interest rates are at 5.5%, it exceeds the interest income. So the problem is, where's the central bank getting this money to basically pay the interest and excess reserve and the Fed's on repo expense? Well, they have to print up $77 billion to basically fund this, yeah? And as we can see here, before 2023, the Federal Reserve ran a profit because the interest income from all its assets was higher than the interest expense. But recently it's reversed. And this is a problem because where is the central bank getting this money from? And as we can see here, because the Federal Reserve was not banking these profits or keeping them for a rainy day, they'll send them off to the US Treasury. They don't have them anymore. And now it's forced to print up cash to basically fund the interest and excess reserve expense and the Fed's on repo expense. And the problem is that the SOMA rate, or the rate on interest or the assets of the central bank, is very inflexible. It doesn't change that much. So as we can see here, the blue line, even though interest rates are very low, it's very inflexible. It takes a very long time. And as interest rates shot up, the difference, you can see this is the printed money. This is basically the profit, the green here. So the Federal Reserve doesn't have this profit anymore. They sent it off to the US Treasury. And now they're forced to print up this amount here to cover the interest and excess reserve expense. And this is the reserves in the system, and it's the Fed on repo. So it's basically 200 billion this is 2015, and 2.5 trillion in reserves in 2015. So if you want to calculate the number of reserves, and this is the formula. So we had no QE or QT in this time. As you can see, the balance sheet did not expand. But what we did have was interest coming back to the Federal Reserve. So we had reserves plus the Fed's on repo, which is about 2.75 trillion. And the average interest on this, or the expense, was 0.025, as we discussed. It's very low. But they also had the 𝐶𝑒𝑛s𝑒. So over here we had in 2015 we had what, 4.25 trillion at 2.68%, yeah? So it's a lot of interest income, and basically you get a lot of deflation. So that's where this 106 comes from, yeah? You look back here in 2015, they had $106 billion profit. That's what we're talking about, yeah? This green. But what do they do with that? They send it to the US Treasury. They don't have it anymore. So the problem is, now that we've gone to the red, they're forced to print up this money. And as you'll see here, when this system reverses, so now in 2024, we have 3.3 trillion reserves and 451 billion in Feds on repo. And basically, it now reverses, yeah? So we have all this going in here at 205, and we have quantitative tightening currently being conducted at negative $800 billion a year, as you can see here on the Federal Reserve balance sheet. But also we have the interest expense exceeding the interest income. So now we have actual inflation on this side of the equation, yeah? Even though this is going deflation, yeah? And as we can see, imagine that we had an oil shock, yeah? Let's say in 1970, you know how 1973 they had a massive oil shock because of the Israelis? Let's look at this. So if inflation skyrockets and interest rates are required to be raised from 0.5 to 25%, what does this mean? Well, let's see. If this goes up, this 𝐶𝑒𝑛s𝑒 rate is very inflexible. It takes a very long time for all the bonds on the Federal Reserve balance sheet to roll over to a new interest rate or to adjust. But in the meantime, all this area here needs to be printed up because the Federal Reserve doesn't have any spare cash to pay it. So as you can see here, we add this in here. So the new rate is 0.25% or 25%. And we have the exact same as before, but now we're getting inflation. So it requires bonds to be sold. And as you can see, this can be a massive problem in understanding. And what I want to leave you with is a basic understanding. So as the average bond duration on the balance sheet goes up, so it takes longer for the Federal Reserve to roll off. Let's say the average bond duration is 2 years, it comes off very quickly, right? But if it's 10 or 30 years, it's going to take a very long time to roll off, yeah? Take 10, 20, 30 years. And when the average bond duration goes up on a balance sheet, the 𝐶𝑒𝑛s𝑒 rate becomes the variance goes down and its volatility basically stays the same. Like it's very inflexible. How do I describe this? If you look at this line here, basically this won't adjust as long. If the duration's even longer, when this spikes, it'll take even longer to roll up. Yeah? Okay, and also quantitative tightening goes down because it takes longer for the bonds to roll off. So when you do passive QT, it'll take longer for the bonds to roll off. Another thing I want to talk about is as the reserves in the system go up, or the Feds on repo goes up and the 𝐶𝑒𝑛s𝑒 goes up, this side of the equation becomes more important because now the costs go up. Because if you have a massive blow up in the interest on excess reserve and the Feds on repo expense, well, now this won't adjust to offset it. And now you're getting a ton of inflation on this side of the equation. And then this basically offsets your QT and it enhances your QE, which means basically you can never raise interest rates because this side of the equation dominates, because this will just exceed your 𝐶𝑒𝑛s𝑒. And what happens here is now interest rates get basically reduced all the way out to zero. And in the case of Japan, as we saw yesterday, you can never raise interest rates to fight off inflation because you just blow everything up.